Hi, thanks for joining me today. I'm Kylie Frazer, the Managing Partner at Eleanor Venture. Eleanor Venture is an early stage tech investment syndicate that makes it easy for angel investors to build diversified startup portfolios that fit within their own investment thesis. We've been going for about 9 months now, and we're already 9 deals in, so we like to move pretty quickly. We work with the big VC firms so we can secure access to some of the most highly sought after seed and Series A investment opportunities. These are some of the investments that we've made to date. One isn't on there because it's not announced yet. And you'll see that in addition to there's 6 direct startups on there and 2 funds. We have really enjoyed bringing those syndicated fund products to our members as well, allowing investors to write small checks to access great fund opportunities like Tenacious Ventures and StartMate, which is the first time that StartMate has allowed syndication from non-mentors. I've been asked to talk about what's going on with seed investment and coronavirus. And the last 6 weeks have been pretty busy, certainly over here at Eleanor, and I'm sure for many of you too. Lots of work with the portfolio, working through various scenario plans and extending runways, to 2 years. Runway extension is, unfortunately synonymous with cutting costs, and in startups, cutting costs it's very hard to do that without losing talent, which is always tough. We've been really lucky at Eleanor, as we're only a 9-month-old syndicate. Our portfolio have all recently raised, so that was certainly easier for us than for many others. Sharing some tips on what I have learned from many conversations with founders, both within the Eleanor portfolio and my own personal portfolio over the last few weeks, being really clear on what their intentions are for future capital needs. If they want to raise capital from external sources in the future, they need to make sure they save some cash to accelerate growth at the end of any hibernation period. Investors will be very forgiving of hibernation periods given the current climate, but what they will want to see is that growth can be turned on before they write a check. So you need to make sure that your companies, if they do want to raise, not just survive through the hibernation period, but have enough capital to turn growth back on when they need it. Second point there, green hat thinking for the Edward de Bono enthusiasts amongst us. Don't forget the optimism. Angel investing is about believing in the impossible, and you've picked these founders because you believe in their vision for the future. Don't snuff that out. There's no need to kill the golden goose. A lot of us will be, as investors, will often be the most experienced, the most seasoned, the most cynical, some might say, people around the board table. And it almost feels like it's our duty to be the bearer of bad news, to make sure those runways go for 2 years, to cut the cost, to manage to that bottom line. And that's part of it. But don't overcorrect, don't kill the magic. You have to, if you still can't see that beautiful future, then, that's probably overcorrecting with the negativity isn't going to get you there. And finally, the importance of peer networks. It's all very good to spend time with your portfolio, and it's a great thing to do, obviously, but don't underestimate how important it is for them to spend time with each other. And this is where having a portfolio is so beneficial, because you can get them to speak to each other. There's always a power imbalance between investor and founder, and there's things that they just aren't as comfortable sharing with you, and lessons that we haven't been through, right? Like we're sitting at the other end of the spectrum. So one of the great things that I've had the privilege of being part of during lockdown has been seeing those bonds develop between my founders, which has been great. They've been fabulous for each other. So thanks, guys. So what's next? Are we open? What's going on with seed investing? We are very much open. My friend at StartMate, the CEO, Michael Batko, put it very eloquently recently when he said, don't try and time the market, plant seeds instead. I'm not sure it has to be instead. I'm sure there's room for both of those things because timing the market can be fun in other parts of the portfolio. But it's really not relevant at seed. These are long-term investments. So if you're investing with a 7 to 10 year plus horizon, a bit of market volatility, a lot of market volatility in years 0 to 2, it's not really going to make that much difference towards the end. So we think it's still a great time to be investing in seed, which, we would say that because that's what we do. But we're in pretty good company. Some of the greatest angel investors of all time have come out saying now is the time to keep going forward. People like Jason Calacanis, Chris Sarker. And if you look at how they invested through the GFC, you'll see that they're not just preaching empty words. This is how they built their fortune. Some of the most valuable companies that we have today in Silicon Valley, companies like Slack, Pinterest, Uber, these were all founded in the years following the crash of Lehman's. And I don't doubt that we're going to see some more great companies coming out of these times as well. And I hope that Eleanor Venture and some of you are along the journey. A lot has been said about venture capital drying up in 12 months from now. And the data that's been pulled showing venture capital deployed after the Lehman's crash supports that, as you can see from this graph. But what we haven't really spoken a lot about today is how angel activity correlated during that time. And you can see from this graph, which is the black line is the number of angel deals in the time period after the GFC, and the light grey bar graph on the x-axis down the very bottom shows the volume of angel capital deployed. While it's true that venture definitely decreased and hit its lowest point 12 months after, angels not so much. In fact, angels showed a steady increase by number of deals. The volume of capital dropped off a little, but nowhere near the same extent of what it did with the funds. And I think what that shows is that sophisticated investors know that the rules don't change with market fluctuations, not when it comes to seed investing. The trick is to keep a diversified portfolio. Don't make big bets, make lots of little bets. Jason Calacanis built his reputation and most of his fortune off the back of a $25,000 investment into Uber that he made, just not long after the crash of Lehman's. However, there's always a however. That doesn't mean that things are completely the same. We've gone out to our network saying that we are now putting these additional screens on new portfolio investments. Can the company acquire customers in the current climate? We're not in the business of funding companies through hibernation. If companies are in hibernation mode, they can come back and get capital when they're out of hibernation mode. They don't need to sleep with my money. That's not fun. Is there 2 years runway or a shorter path to profitability? Because we do predict that follow-on funding for Series A and below will be harder to access in the next 12 to 24 months. And is this product still as relevant in a post-COVID-19 world? And what is a post-COVID-19 world? Isn't that a fun thing to think about? I'm going to decline from positing any views on that in this call. I think that could come back to haunt me. But what I did do is I went back to our 2020 investment themes, which we published in January. And I think they look pretty good. There's not a lot that I would change from our initial outlook for the year. Capital efficiency remains more important now than ever. And it's not just because times are tough, and capital and equity investment is going to be harder and harder for founders to obtain. I like capital efficiency all the time because I like balanced cap tables. I don't want founders to raise $1 more than they need to, because I always like the effort to be aligned with the incentives. And if you have an unbalanced cap table where investors have more and founders don't have enough, not only do you make it hard to raise further rounds, but your founders aren't going to be there in the trenches when you need them to be. No one wins. So we like to keep things very aligned, and capital efficiency is the easiest tool to do that. Sustainability in supply chains. When we wrote this, we were more thinking about the importance of visibility into supply chains, driven by things like the Modern Slavery Act and a trend towards environmental sustainability and more generally. Now you've got the additional lens of supply chain security, which is going to make supply chain an even sexier area to invest in, which delights me. And the last one, privacy and consumer data rights. Again, it's going to be huge. We've all seen the enormous download? What's the uptake in downloads of the COVID Safe app that the Australian government has put out? That is perhaps indicative that consumers are willing to trade short-term privacy concerns for long-term public health interests. You've had the bizarre situation when Europe, normally one of the great defenders of privacy rights and the architects of the GDPR system, are lobbying the tech giants to enable tracing apps. That's just, who would have thought that would have happened? So all these developments means that the tech that underlines privacy concerns is going to be so much more valuable and super important in the period to come. So I'm happy with my investment themes. If you're a startup who's listening to this, come and see me if you're working in those areas. The only thing that I would add to that in thinking things forward is I think it's going to be tough for consumer for the next 12 to 24 months. So we would probably keep the focus on enterprise until we see what's happening in the macro trends. Alrighty, I think that's it for us today. I think I'm going to Q&A shortly, but if I don't answer your question, feel free to hit me up in the email directly. Thanks very much.